Imagine you getting ready for a podcast is very similar to what it's like for Nicolas Cage to get ready for a movie set, because you got to get that water, right? And you got to get that caviar from the Anchorage Basin only.
Cheers.
You got your hair all right, your glasses on.
Yeah.
We're finally ready to go, hopefully.
Yeah, that's my morning routine is the caviar in the morning. That's probably like one of the worst foods you could eat for breakfast.
Why is that?
Fish eggs. Because it'd make your breath stink. It's like onions and fish eggs and garlic.
Yeah, that's true. That's why we're doing this long distance.
I've never had, yeah, right. I've actually never had caviar.
So what I wanted to get into today, Derek, I know we were trying to make these podcasts a little bit shorter. That way, hopefully we could do them a little bit more often. We've been slammed lately, and I want to get back to it. I know we've done a lot of the videos on Instagram, so people hopefully have been able to pick up some information there. And on Instagram, I did a video on the importance of creating a investor engagement letter with yourself. If you're a do-it-yourselfer, why is that important? And it came to me because I was working with a client who had been investing for about 2 years. And if you look at a lot of the studies will show, if somebody's a long-term investor 30 years down the road, a lot of that has to deal with what their experience was when they first started investing, right? So if you started out investing in the market in 2008, your experience was really bad, right? And if you look at the past 2 years, equity markets, depending on what you've been invested in, if we're market cap weighted, we've done pretty good for the year. But everything else, value, equal weight, equities has suffered, is still down for the year, right? So taking into consideration 2022 and 2023, it's been, to say the least, a rough run for some people, especially if they look at past performance and they say, hey, I thought I was going to get that 8 to 10% return in this account, right? Because people will cite the stock market and say, I expect to have an 8 to 10% return. But Derek, that, as you and I know, that is over a multi-year time horizon, 5-year plus, 10-year plus, ideally 20-year plus is what we're looking at. So my reason for saying this is I want to go a step beyond that. So for those of you who missed it, what is an investment engagement letter? An investment engagement letter simply states out what the goal of the plan is, right? What's my ultimate goal? Is it retirement? Is it saving for college? Is it buying a house? Is it starting a business? Because that goal, number one, tells the time horizon, Derek, how long I'm going to be invested. Once I know that time horizon and I know that goal, I know what I want to achieve, I can reverse engineer it. I can figure out what investments I'm going to have to own to give me the horsepower to reach that goal. Or if the goal is preservation of principal, again, I know what investments I can be in to preserve that principal over time. But the other thing that you want to do with a bear market plan, with an investor engagement letter, is create that bear market plan in times when things are good. Because my analogy would be, you don't necessarily want to go to the grocery store when you're starving, right? Because you're going to end up buying everything and anything and probably things that are not great for you. So the same thing with a bear market plan. What a bear market plan is, how am I going to act when things around me are going crazy? When the market's selling off 20% or more, how am I going to allocate my funds? And you want to make that decision with a clear mind. You don't want to make that decision in the moment when the media is blasting 24-hour coverage of the stock market collapse. So I think the ultimate results in creating that client engagement letter with yourself is the focus shifts from your investment account only to the long-term goal of the plan. That way we're making long-term decisions and we're not making short-term reactions to things. And I think you're going to have greater success with that client engagement letter. But I wanted to share 2 more hacks that I think you can do as a do-it-yourself investor to keep your eyes on the prize so that you're not making mistakes in the short run. The first thing, and I actually came across this in one of my CFP books here, Derek, is they had a chart which showed and I'm going to send this to you, Derek, so that you can put it up on the screen. They had a chart that showed the annual savings rate and how long it would take you to get to $1 million based on how much you're saving and how much you're returning in interest. So for a lot of people, saving $10,000 a year would be a pretty substantial portion of their paycheck, right? And at a 6% return, that's 34 years. So saving 10% per year, earning 6% every year as a compounding rate of return, I'm looking at 34 years before I reach that. That's at 6%, at 4%. So if I'm in a conservative investment account because I don't like to stomach a lot of volatility, that 4% is going to take me 41 years before I reach that $1 million. And I think that chart is good to look at because it makes things real as far as I think the average investor will save hoping that it works out, hoping for the best, hoping they're going to get that miracle return that gives them 100% return or something like that. But chances are we're not. It's going to revert back to that mean of an average return. So different ways that you can enhance that, right, Derek? What you can hopefully get a greater return, but what's that going to require? It's going to require taking more risk, or we could save more. But the other thing that's really eye-opening is looking at that and then considering an inflation-adjusted return. So the way that you would figure that out is you take the return divided by the inflation rate, and then there's a little formula there. For example, if we were getting an 8% return and the inflation rate was 3%, my inflation-adjusted return is 4.85%. So that, I think, is also eye-opening because when you're calculating this, if I'm saving $10,000 a year, what you really need to do to make that $10,000 to make that $1 million spend like $1 million today is you need to increase that savings rate by the inflation rate as well. So if I'm saving $10,000 per year, the next year I need to save $10,300. The next year I need to save $10,609. The next year $10,927. But things like this, I think, are important that when you look at them on paper, then it makes them real and ultimately allows you to focus on the long-term goal rather than getting caught up in the minutia of the moment.
Yeah, you said you need a bear market plan. I mean, it might also be a good idea for a bull market plan as well. Like when things are so bad and so in the most recent drawdown, you're like, I don't like the amount of volatility that my account experienced. So then in the next bull market, like warning signs to look for, where you're like, oh, we're not going to jump into Dogecoin at the top of the market. And so when some of these things start to pop up, like the IPOs get crazy, the SPACs get crazy, the crypto coins get crazy, it's like that's probably the time where you want to count your blessings and kind of batten down the hatches and don't keep putting your chips down on red.
Yeah. Well, we were looking at a chart that showed that the average PE of big tech right now is somewhere around 29, and the historic mean is somewhere around 18, right? So that doesn't necessarily mean that the bottom's going to fall out tomorrow, but it should at least give some warning signs that, hey, if I'm going to allocate a lot of money to this, this might not be the best opportunity to do that. We've talked about market timing in the past. We try not to market time, but there are times when you look at this and say, man, it is pretty frothy.
Yeah, right. Yeah, it's tough because, the traditionally defensive sectors of the market have not acted defensively at all. The only sector that has acted defensively is like the information technology and the consumer discretionary, which is like completely counterintuitive to how markets have behaved in the past. But part of that is just because those tech companies just have like really high margins and there's a lot of demand for their products. So, it's almost like those discretionary baskets are not even discretionary anymore because it's like people are willing to cut out other stuff before. They're willing to cut out movie tickets for DoorDash or something like that. Like people are still getting their food delivered. DoorDash had like a fantastic quarter. It's just we kind of diverted, but like it's just the market behavior so far this year has been really interesting to watch.
Yeah, and I think you need to take it. You need to back out, right? And you have these moments that don't necessarily follow as they traditionally would, right? So consumer staples are traditionally a defensive sector. It really hasn't been defensive this year. They've underperformed by quite a bit. Healthcare has traditionally been a defensive sector, underperformed. But I think sometimes we look at this and we think that things have changed. It's actually probably more probable that these are anomalous years, and then eventually it will revert back to historical means.
Yeah, I agree. That's kind of my view as well, I would say. Just because, the consumer has been much more resilient than people have expected. But, you keep coming back to these long variable lags of monetary policy, and you look at how long previous rate cycles have taken to actually impact the consumer. And it's kind of like the performance of these like super discretionary sectors, that's kind of anomalous, but that's kind of new. But the long variable lags and the consumer remaining resilient longer than everyone originally thought, that's kind of par for the course. These rate hike cycles take a really long time before it actually gets to your checking account.
Yeah. So Derek, today is Sunday. We're recording this on Sunday because we knew that we would not be able to squeeze this in. A lot of people are getting ready for the NFL games that are about to happen today. But I know a lot of them are also going to be interested to find out later this week what's going on with long duration treasuries. Can you fill us in on that?
Wait, did you say you have? I thought you said you had one more hack, or was that? Didn't you say you have two?
No, that's my two hacks. That's my two hacks. My one hack is that you need to look at the second one is you need to look at the inflation adjusted return.
Ah, gotcha. Okay, good recap. That was
So
a good
you need to
recap
look at
for
that.
me.
Yeah. That table that shows how long it's going to take to get to $1 million, and then also adjust that for inflation because that's
Nice.
eye-opening.
All right. Apologies. Sorry. So sorry I
I'm glad
ruined
you're
your
following,
segue. You had a really great segue and I ruined it. I'm sorry. But basically, yeah.
Wouldn't be the first time.
But last week, this was on the 9th, November 9th. There was a really bad auction for U.S. 30-year Treasury bonds, and it's actually by one specific metric, it was actually the worst of all time. Like, it's never been this bad. So just kind of give you a background on Treasury auctions. Is there's always demand for U.S. Treasuries. There's always going to be a buyer because they're basically like the motor oil of the financial system. There's always going to be a buyer, like, because I mean, like, if you like use us for an example, if you have money in an investment account, the cash with SCI is going to be sitting in a money market. Those money market funds are backed by U.S. Treasuries. Banks need to hold them. There's certain entities that are like regulated to the extent where they are required to participate in Treasury auctions. So there's always going to be, no matter how much money the Treasury tries to issue or how much debt the Treasury tries to issue, there's always going to be a buyer. The only question is what yields are those bonds going to get? I mean, theoretically, you could imagine if there was actually no liquidity, then the yields on those bonds would be 10,000%, and you would between 0 and 10,000%, you would find a willing buyer. That's kind of how these auctions are designed to work. So just a quick recap: bills are 3 months to 12 months maturity. Notes are 12 months to 10 years, and bonds are 10 years or over 10 years, all the way up to like 30 years. So they're auctioned off with competitive and non-competitive bidders. Competitive bidders would be primary dealers. Those are going to be like the large multinational banks like the JP Morgans, the Citigroups, the Goldman Sachs, and they are going to exist to, they're going to either buy it for themselves, but more than likely they're going to buy it for their clients, let's say, or they're going to buy it for many other purposes. Hedge funds are competitive bidders. They will kind of like, sorry, let me back up for a second. So the competitive bidders care about the yields that they're getting. That's the thing that makes them a competitive bidder. And then the non-competitive bidders would be like individuals where they're just like, I want the Treasury bond exposure, so they're just going to buy Treasury bonds. But the competitive bidders, so you have these Treasury bonds are auctioned in a Dutch auction. If you don't know what that is, that's basically where it's auctioned off. The thing you're about to buy is auctioned off at the highest price, and then the price is systematically lowered until it finds a willing buyer. So Treasury bills, bonds, notes are inversely, the price is inversely related to the yield that you get. So it's going to start off at the highest price for the bill or the bond, and then that's going to be the lowest yield, and then the yields are going to increase until it finds a willing buyer at every price. So so the measure that people look at to see if it was a good Treasury auction or if there's liquidity in the Treasury market is the spread between the price that's initially offered, that initial offer price, and then the highest yield on basically the last buyer to buy that Treasury bond. In this past week, it was the highest spread between that number in the history of Treasury auctions. So it was issued originally at 4.716%, and then the highest yield in that auction was 5.76%. So the spread was 100, or it would be 1.053%. or like 1,053 basis points or whatever is the spread, and that was the worst. So it's basically signaling something that we've been talking about a lot: is there's less international demand for these treasury bonds because you have entities like Japan, China, like all these countries also demand treasury bonds, but it's going to be to a less extent because they're worried about stuff in their own country. Or I mean, basically, the reason that the yields are this high in general is because like people are worried about inflation expectations. There's a lot of things that we talk about a lot, which is why the yields on these long duration bonds are getting so high.
Yeah. I think I wonder how much of this also has to do to the fact that we, and there's no way of me knowing this, the fact that we weaponized the treasuries a little bit when we, with our dealings with Russia. I mean, how many people, other countries, foreign entities, especially as the world is kind of going away from globalization a little bit, how many other countries want to store a bunch of money in something that could potentially be frozen or, create problems where they can't get that wealth back.
Right. And I mean, just think of like this is an illustration that we talk about all the time. It's like if I were to ask you personally, if let's say I had the best credit score in the world, and I was going to lend you money, I was going to borrow money from you. What rate of return would you require from me if you were going to lock that money up for 30 years? There's not many people that would say 5% just from the aspect of locking it up for that long. Not worried about credit quality at all. But I mean, for 30 years, it just seems like most rational people would require a much higher rate of return than 5% to lock up money for 30 years.
But you know what's crazy? For the longest time prior to this, when long duration treasuries were at 2%, people banks were locking that up, right? People were locking that up. Inflation was low. And there was a time, I think, where people thought, is inflation behind us? Has technology solved this problem for us where things are getting cheaper and cheaper? Globalization is solving this problem for us because work and these products are getting cheaper and cheaper. And then we saw the problems with that with COVID. You have now reshoring effects coming in. What reshoring is bringing the manufacturing back to the country that's manufacturing or producing it. That's going to lead to inflation. It's going to lead to higher costs right down the road. So to your point, all you have to do is think back to July of last year when the inflation rate was 9.1%. And I don't think it's out of the realm of possibility that happens again sometime in the future, right? And do you really want to be holding an instrument that pays 5% and, Derek, 5% and getting taxed if you're holding it outside of an IRA when the inflation rate is way higher than that?
Yeah, go back to your inflation adjusted return. I mean, your inflation adjusted return on 5% would be, and then factor in any inflation rate you want. It's going to be higher over the next 1 to 2 decades than it has been in the prior 2 decades. So it's going to require a much higher rate of return from investors. But you made a really interesting point there about everybody, all the individuals. If you even remotely pay attention, you're going to be like, hey, I have an opportunity here to refinance my house at 3%, or I can take a loan out on a car at 3%. And the only entity in the world that didn't take advantage of that is the U.S. Treasury. Like they were issuing short duration bonds. It's like, why did they not take? If they knew that they were going to run these large budget deficits, why on earth were they not issuing 30-year debt at 2%? But instead, they issued it at the short end of the curve, and that's coming back to bite them because now they just have to constantly keep reissuing these T-bills. Because I mean, if you look at all these auctions, this is actually. Let me pause here and make an important point. This Treasury auction that I'm talking about here, it caused TLT to sell off 3%. Stocks fell over 1%. I think the NASDAQ was down almost 3% on the day. This was markets did not react good to this. And this auction was for $24 billion in bonds. $24 billion in bonds. And we're issuing like trillions of dollars a year. We're running $1 trillion deficits. So this shows the thing that we talk about where who's going to be the buyers of these long or who's going to be the buyers of our debt. Our credit quality is getting worse, and yields are going to have to go higher. And there's not as many willing buyers as there were in the past 10 years, and yet we're still running these massive deficits. It's like this is actually becoming this is the part of the game where the irresponsible fiscal spending is actually having consequences, and people are actually like kind of checking the United States and being like, hey, the free money show is almost over. It's like we're actually going to have to do something. Like it's not going to be the situation we have been in the past 2 decades, where there's a constant buyer at any price that we're willing to issue debt at.
So I got a text from you over the weekend, sometime around 11 o'clock or something, and it pointed out that Moody's, I believe, or you stated, is the only credit rating agency that has the U.S. debt at AAA.
Mm-hmm. And then they issued
I believe they've issued a
like a warning sign. They issued the outlook as from neutral to negative. So that means we could be in a situation where all three credit rating agencies have U.S. debt at AA rating, which is still funny because Microsoft and I think Johnson & Johnson, I think there's one more, but those two companies have AAA rated debt, so they'll have higher credit rating than the United States, which is kind of hilarious.
Yeah. So for our football fans who are getting ready to put brats on the grill right now, explain to them what is the likely scenario. So they start holding auctions. We don't have buyers, not enough buyers. Who becomes the buyer, and what is the consequence of that?
So
that's something we can know at this point.
Yeah, so I think that it's going to be the private sector in the United States that ultimately ends up, because like the primary dealers are regulated to the extent where they always have to participate in Treasury auctions, and if the yields get high enough. So if I was going back to our example about me and you, if you were going to lend me money and I said, I'll give you 10%, I mean, now we're talking. So we're talking about somebody that cannot actually default on the debt because they can always print money. You're always going to get that 10% return. People would start to step into the market at that point and be like, okay, it's like, yeah, I might get 5% inflation adjusted, but 10% over 30 years is pretty solid for somebody that is not capable of defaulting, at least in nominal terms. So that's ultimately what's going to happen. But the caveat to that, where we've had always really strong demand, especially from Japan, about buying our debt, that's going to become a problem because like other countries are coming in, or Japan in particular is having issues with their currency. So they're going to, like, to defend their currency, they would have to sell U.S. treasuries, which is basically like selling dollars and buying their currency, or basically defending their currency by selling U.S. dollars is kind of how you can think about it. So there's going to be less foreign demand for U.S. treasuries. So that's just one more example of why the liquidity in the Treasury is not going to be as good as it has been in the past 2 decades.
Fantastic. Kind of a glum picture, but I think to your point, in reality, we've kicked the can down the road so long on this, and I think now you're starting to see the effects of the financial situation that we're in. But I mean, is it something that as an investor needs to be worried about today?
No, it's just like one of those things. It's like,
treasuries?
no, like I said, there's not a sorry, my dog was barking. There's not a possibility that the U.S. is going to default or anything, but like it's like that thing when I don't know if you and your friends do this, but you sit around and you're like, man, this world's messed up, and like the people in Washington are so irresponsible. They spend all this money, but it's like. You're just talking, right? There's no like actual, like, your day-to-day life is going to be fine. Like, this is actual example of like something that's starting to change. Like, the consequences are actually starting to pop up. Like, obviously Treasury auctions don't really have much effect on your day-to-day, but I mean, if this continues to play out over the next 10 years, that's when it actually starts to because I mean, this has implications for the amount of money that the Treasury is going to borrow. So I mean, a couple steps down the road, and they're like, have to make cuts to Medicare and Medicaid. They have to make cuts to Social Security. They have to make cuts to the defense budget because they can't issue debt like they could before. So that's kind of why I wanted to talk about this thing that sounds inconsequential, but I mean, this is just an example of something that will eventually have consequences if this continues. This will impact your day to day if this continues.
Do you know what else I also learned? I also learned that there's a difference between the inner workings of a Dutch auction and a Dutch oven.
Nice. Do you want me to cut that out?
Can we end on that?
Yeah, we can end on that.
All right. Derek, where can they find us on social media?
As always, thanks everybody for listening to the podcast. If you liked it, like, share, subscribe, wherever you get your podcasts. Follow us on Facebook, Instagram, YouTube at Crosby Advisory, and we'll see you guys next week.
Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Texas, and Florida. Anytime you can request our forms ADV 2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I may have mentioned specific securities, and that is obviously not a recommendation to buy them, sell them. Do your own homework and make sure they are suitable for you. Keep in mind, investing involves risk, including the potential loss of principal.